Chairman Volcker was dealing with double-digit interest rates. He took interest rates from 10% to 20%. Now, by the time he did that, consumers and businesses had gotten used to maneuvering around inflation. So while that sounds shocking, going from 10 to 20%, and it did have some shock value, it wasn't the same as what we're experiencing today with Chairman Powell and the Fed. Today, we've gone from 0.25% on the Fed funds rate to 3.25, which is a 13-fold increase.
With all focus now on the U.S. Federal Reserve's next move, ARK Invest CEO Cathie Wood is convinced that another 75 basis points interest rate hike will be a huge mistake for the global economy. In a recent episode of her monthly In the Know series, Wood discusses M2 growth, why she believes the Fed is making a mistake, and the recent near collapse of the British pension fund system. According to the popular hedge fund manager, Fed Chair Jerome Powell's Volcker worship will cause nothing for the U.S. and other economies. After 5 interest rate hikes with 3 consecutive 0.75% hikes, the Federal Reserve is right on track to deliver another massive hike come November. By all indications, the central bank aims to raise the benchmark interest rate to 4.5% and hold it there while not ruling out the possibility of more hikes if inflation remains elevated. In addition, September's strong jobs report and the impact of OPEC's oil production cuts on energy prices strongly suggests that we're getting another 75 basis point hike in November. Earlier in the month, Chicago Federal Reserve Bank President Charles Evans, who traditionally has been more dovish, had this to say about the Fed's trajectory for next year. We look to be, according to our reports, headed for 4.5% to 4.75% by sometime next year. According to Cathie Wood, the Fed is focusing entirely on lagging indicators and ignoring forward-looking ones that are already signaling serious signs of trouble. We will now take Cathie Wood's latest ITK broadcast. Please watch, share, and like the video. Also, ensure you subscribe to the channel and turn on post notifications for more videos like this. Thanks, and enjoy the video.
M2 growth peaked at 27% in 2020 and has been slowing ever since. It hit 4.1% in August. We believe it is closing in or might be below 3% on a year-over-year basis in September, which doesn't leave a lot of room for growth or inflation unless velocity is really picking up, the rate at which money turns over. And we're in an environment where we do not believe velocity is picking up. If anything, I think individuals and businesses are becoming more concerned and are spending less freely. If you look at M2 also, you'll see that it actually peaked in March. Now, this is very unusual to see sequential declines in money. We have not gotten back above that March peak, and we may not get back above it the way that Fed policy is going. And I think I'd like to build the case a little more here that the Fed is probably making a mistake. I say probably because I have to from a compliance point of view, but I really do believe the Fed is making a mistake. Reflecting a little bit more on the Jackson Hole speech that Chairman Powell gave in late August, we've come to recognize that Chairman Powell really does think he is the reincarnation of Chairman Volcker, that we need him to take a sledgehammer to inflation, much like Volcker did. And history has treated Chairman Volcker very kindly. He did turn the tide on inflation. Now, what he did, though, was he turned a tide that had been building for 15 years. It started in 1964 with the Vietnam War and with the Great Society. So many social programs started at that time under President Johnson. And for 15 years, fiscal and monetary policy pretty much went rogue as we look at history. Even after shocks to the system, like the oil embargo, and the stimulus that came about because of it, both monetary and fiscal policy. We never saw the kind of slowdown in monetary and fiscal policy that we're seeing right now. Federal spending is still down 14% on a year-over-year basis. You never saw a decline in fiscal policy spending in the 70s. Monetary policy seemed to be on automatic pilot back then. The dollar was getting crushed toward the end of the 70s, adding to the inflationary fire. And so Chairman Volcker did choke off money supply and killed inflation. It took a long time for people to believe that inflation had peaked. In fact, I don't think many people believe it peaked, as it did in 1981, until 1986 when oil prices crashed. So the inflation expectations were embedded in the system, and it was very difficult, and Volcker did a masterful job. So that was over a 15-year period that inflation had built. By the time the Fed got around to tackling it this time, it was not a 15-year problem. It was a 15-month problem. And from our point of view, it was caused primarily by shocks, major shocks to the system that we had never seen before. We had not had, since Spanish influenza, a global pandemic. And we did not have the supply chain problems, 2 years worth of them, that we had because of the COVID panic. And then, of course, we had another shock to top those off, and that was Russia's invasion of Ukraine. So these are shocks to the system. This was not a period of embedding inflation expectations. And yet, Chairman Powell is taking a sledgehammer that is actually bigger, much bigger. It's at least 6 times bigger right now, and could be 8 to 10 times bigger if the Fed does raise the Fed funds rate another 75 basis points on November 2nd.
In her broadcast, Wood explains further that before former Fed Chair Paul Volcker's aggressive rate hikes, the benchmark was already at double digits. Volcker and his Fed took the Fed funds rate from 10% to 20% to combat a 15-year high inflation in the early 80s. Wood added that since inflation had been around for 15 years before Volcker, many individuals and businesses could easily maneuver their way around the situation. But the case is different under Powell. Firstly, inflation had only been around for 15 months, and instead of a double-fold increase, we had a 13-fold increase, with the benchmark rate going from 0.25% to 3.25%. Wood also explains that the impact of the interest rate hikes can already be seen in and out of the country, beginning with the near collapse of the entire British pension fund system.
Many people, I was interviewed by someone the other day and said, oh yeah, but that was such a low base. There's no comparison. In fact, that makes this even more dramatic. That's what's so interesting. People dismiss this way of thinking about it, saying, oh yeah, but the base was so low. The base was so low, and it had been really since 2008 and 9, because we were in a terrible crisis then, and it took a long time to get out of it. And so we did not have inflation expectations built into the system. I really don't believe at all. And yet Chairman Powell is behaving as though what's going on today with inflation is much worse than what Volcker inherited. Starting from a low base is really shocking the system, especially given how long interest rates have been low. So I question the premise of those who say, oh, this is so different. It's such a low base. That's the whole point. It's a low base, 13 times. So if they raise the Fed funds rate another 75 basis points, this will be a 16-fold increase compared to Volcker's 2-fold increase. Now, we have been expecting serious ramifications, financial and other ramifications, because of this monetary policy. And we've gotten the first one. But most people here in the United States are not aware of it or haven't thought very carefully about it because it doesn't seem to matter to us. But I was in the UK around the time that it had its near Lehman moment. Near Lehman moment means the financial system implosion. And that was just about 10 days ago. Now, what do we mean by that? Well, there is something called LDI, liability-driven investing, and it's where pension funds match their liabilities with assets. So they will, in its pure form, they will match one for one the amount that they have to pay out to pensioners as they retire. Now, it would be great if they did match assets with liabilities completely from a safety to the system point of view. But they don't. And with banks, and a very low interest rate environment, they got used to using derivatives and taking shortcuts to try and accomplish the same goal. And after a very long period of very low interest rates, no one expected a sharp increase in interest rates. Well, once that happened, pensions began getting margin calls, and they couldn't meet them. And in fact, if interest rates had gone to 8%, and I think they got to 6% over there, if they got to 8%, then according to some of the people close to that situation, whom we have consulted, then the pension system would have collapsed. But it wouldn't really have been the pension system. What really would have collapsed if the pension funds were not meeting those margin calls were the banks, the counterparties in this case for these derivatives. And so the Bank of England had to step in.
The chance of a Fed pivot in November is quite slim, but more rate hikes could have far-reaching consequences for the economy. What are your thoughts on Cathie Wood's ITK broadcast? Please drop your comments and observations in the comments section below. Also, ensure you hit the like button, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching our videos.